Hello and welcome. My name is Sandy Hood and we're looking at gearing. Gearing is a topic which crops up in a lot of different accountancy areas. I tend to focus on CIMA and ACCA, but I'm sure that the content of what we're doing at the moment will be applicable to anyone. That's what I look like, and we're going to look at three questions. What does it mean? Why do firms have gearing, and how is it calculated? Gearing is rather like the gears that you might have on a bicycle. What happens is that as you pedal, you're able to change gear so that the bicycle wheel can go around faster than the number of times that you pedal, and that way you're enhancing the speed that you can travel at without having to put in a lot of extra effort. So gearing is something similar in a financial sense. Here the shareholders' return can be increased if the firm borrows more money and therefore uses borrowed funds in order to generate more profits, and those profits can be turned into higher shareholder returns. So we've got these two types of funds that go into an organisation. This is the capital structure, as it were, made up of the debt capital, the borrowed money, equity capital, the shareholders' funds. Now, clearly, the relationship between the borrowed and the shareholders' funds is going to vary from one firm to another. At the highest level you could have, although I've never actually encountered a firm that has this, 100% debt and no equity. And at the other extreme, you could have a firm that has no debt and has 100% equity. And that is represented by the orange triangle. And the blue just shows the way in which this sort of moves as you start to increase the level of gearing. But gearing, certainly at a high level, adds financial risk. And this is a commitment. You see, when you borrow money, particularly if you borrow money from the bank, then you are signing a legally enforceable contract. And on that contract, your loan approval will also include your commitment to pay your interest and your repayments on specified dates, and non-payment of those amounts would constitute a breach of contract. So it's a commitment. And Mr. Micawber in the Dickens novel David Copperfield referred to misery as being a scenario where your expenditure was greater than your income. But we'll take an example here. A company has got a 20 million project, and this project will add $1 million to the operating profit every year. So it looks very, very good. But we look at the first year and we can see that they're going to make 10 million in extra revenue. Wow, a lot of extra revenue. 7 million in extra cost of sales, increasing the gross profit, and ultimately the operating profit will increase by $1 million, which is 10% of the sales revenue. But if they've had to borrow the money, they've had to borrow the 20 million in order to launch this project, they're going to have to pay interest on that at 6%. If you include the interest, you see how that then wipes out not just the profit, but it actually moves them into a loss scenario. So this is where gearing can be regarded as a burden. And interest on the debt that you've taken out can eat all of the profit. So gearing here shows what proportion of the firm's finances have been borrowed. And as gearing increases, the financial risk faced by the shareholders also increases. We move on to our second point, which is why firms have gearing. Well, it gives them more money to invest. They can invest it in one of many different areas, but the ones that I've listed here are working capital needs, expanding the non-current assets, or developing the workforce, or even increasing the number of people who are working for the organisation. Now, I'm going to tell you, it's cheaper to borrow than it is to increase the number of shares that you've got. We know the downside of borrowing, the contract, the locking in, but the lender's protection is good for you as a borrower because it means that the lender has taken lower risk. Now, here I've got risk and return compared with each other. The return at a low risk tends to be low, and the return at a high risk tends to be high. And lower risk for the lenders will mean that they will accept lower returns. So that's why it's cheaper. Here I've got a comparison of, at the moment I've got a red circle around the investment grade corporate bonds. These are bonds that would be issued by large corporations, Tesco's or someone similar. And then above it I've got the blue chip equities, in other words shares issued by similar companies. And the straight black lines show that the risk for people buying bonds or lending money to the company is lower, and therefore the return that they earn on their bonds is lower. Of course, that means it costs the borrower less. And the dotted line shows it's a higher risk when they buy the shares, therefore they get a higher return, and it costs the company more. So borrowing is cheaper than using equity. Now, how do we calculate gearing? This is a tricky question, and sometimes when you read introductory textbooks, it gives you the impression that it's very straightforward, you just divide one figure by another. But the more books you read, the more you see that there are several different ways of approaching the financial gearing calculation. I'm going to look at three. I think that these are the most common that we will come across. But it really depends on what do we want this gearing figure to tell us. If we are measuring the ability of the shares to generate some return with a fairly low level of risk, or at least some idea of how risky they are, then this is the approach that we would take. What proportion of the total capital in this company has been borrowed? So part of the capital is the equity, part of the capital is the debt. What proportion of that total has been borrowed or is the debt? And that's going to show people like Mr. Capri exactly how risky they are. So we take the long-term borrowings and we divide it by equity plus the long-term borrowings, and that would give us a value. That would give us the percentage gearing. In this scenario, I've got a company with 36 million shares. They're all trading at about $3 per share at the moment, giving a valuation of 96 million on the stock market. I've also got 20 million of debt, but these are bonds. These are $100 bonds. They're trading at $120 per $100 bond, meaning that they've got a market value of 24 million. Therefore, we've got total capital employed of 120 million. Of that, the debt is 20%. Okay. Our next scenario is someone, perhaps an accountancy student, looking at the impact, perhaps, of the level of gearing, the level of debt compared with equity, on the return that the shareholders would be expecting. For this, we would tend to be looking at this relationship of the debt and the equity rather than the debt and the total capital employed. So we just divide the long-term borrowings by the equity. Here, same set of figures, the debt was 24 million, and that represents 25% of the value of the equity. Our third one is a credit controller looking at a prospective customer and wanting to assess the safety in allowing that customer to have some credit. And here, you'd really want to look at all the borrowing. I've got a rather extreme example that I can show you in a minute, but certainly all the borrowing would include the short term or the long term. It doesn't matter which borrowing it is, all of it's included. And again, all the borrowings plus the equity would be on the bottom of the fraction. So in this scenario, I've got a company which in 2020 had long-term debt of 84 million. It had short-term debt of 16 million and it had equity of 100 million. Now, fair enough, equity fluctuates a little bit on the stock market, so equity's dipped a little bit in 2021 and it's now 96 million. The long-term debt has dropped dramatically. It's dropped by 60 million. Now, this suggests to me that some of the debt was due for repayment and the company was not able to finance further growth with long-term debts. They applied for it and then they were turned down. But they managed to secure some short-term debt. And what an enormous amount of short-term debt they got. So it went from 16 million to 80 million. These are things like bank overdrafts, short-term loans and so on. So looking at this, the total capital employed is 200 million, which is fine, 96 plus 24 plus 80. But 104 million of that is borrowed funds. Now, certainly from my point of view, if I was credit controller looking at this, I would want to look into more detail before giving a thumbs up as far as this particular company being allowed credit with my firm. But there you are, a 52% gearing ratio identified there. I hope you've enjoyed watching this video. My name's Sandy Hood and I'm available through the Facebook as Accountancy Tutor, and I've also given you my email address. And thank you very much for watching this presentation, and I hope you found it useful. I do classes in a hotel near Arundel,